Okay. This is Rhonda Thomas for Financial Accounting. We're going to work on Chapter 6's intro exercises to get you into the asset inventory in a little more in depth. That's what Chapter 6 does. Chapter 7 will be cash. Okay, these are both assets, which, if you remember, assets have a debit normal balance. Okay, inventory is reported on the balance sheet, and we want to control inventory for safeguarding to make sure it doesn't get damaged or stolen. We also want to make sure that the inventory we're reporting on the financial statements is accurate with what really is physically in inventory. And I have this here from the book. It says reporting inventory, a physical inventory or count of inventory should be taken near year end to make sure that the quantity of inventory reported in the financial statements is accurate. So if we go out and count inventory and find out that we have a discrepancy with what is in the computer, we've actually got to do a journal entry to do what's called inventory shrinkage. Okay, inventory shrinkage. And sometimes, a lot of times things happen and you can't do anything about it. So you just try to follow what is recommended to do for your particular industry, right? But I just wanted to make mention that when you're talking about inventory, it is something you're going to sell, right? So, for example, if you're a car dealer, and you've got a car lot full of cars to sell, that's your inventory, right? But if you've got cars that people use while their car is being serviced or something like that, that car is not inventory, right? It's more like a supply or an equipment that would get depreciated. So inventory is not depreciated. Inventory is sold. Okay, what's in inventory makes up what we are learning is the cost of the goods that you sold. All right, so here's what we've got to think about. So here's what I want you to know: the cost flow assumptions. We're going to learn three. Okay, we're going to learn three cost flow assumptions that's going to work with what's called perpetual inventory, and the other one's called periodic inventory. We're mainly going to focus on perpetual. But what I want you to know is that the first one is called first in, first out. If you don't mind, maybe you guys could find, Casey, maybe you can find how O'Reilly's does their cost flow assumption, but there's something called first in, first out. If you'll put the word cost in, first costs in, first costs out, you'll put that word cost in the middle. That'll help you remember what you're tracking, right? Because costs change, right? Costs change for items that we sell. So we have first in, first out. So the first costs that are sitting there in inventory are going to be the first ones sold. The next one is called LIFO. LIFO, last costs in, first costs out. Okay. And then the final one is called weighted average. And weighted average is basically what I think most businesses use. They have a pile of inventory of an item, and they've got the costs averaged out for each item. Okay, so we're going to walk through how to do this pretty quickly. All right. Once again, here are the specific methods of cost flow assumption. Now, if you're a car dealer, okay, you know exactly how much each car you have costs you. Okay, you don't lump those together. No. Okay, so this is the cost flow assumptions we're about to go through, has to do with businesses that have lots of inventory of like items. Okay, they call those homogeneous items. So first in, first out is very popular. Last in, first out is done for tax income tax reasons, and then weighted average seems to be the easiest to do or keep track of. All right. The other thing I want to mention one more time is perpetual inventory. Perpetual inventory means that the inventory system is kept up to date for every sale. So every sale that we make an entry to cost of goods sold, and we make that inventory go down, which was what was in chapter 5. If you haven't done a whole lot with chapter 5 yet, every time we make a sale in perpetual inventory, we lower the inventory at the time of the sale. Okay. There's another inventory system called periodic. Periodic, you do not lower inventory at the time of sale. You check how much was in the beginning and what was out there at the end, and then you make the assumption that that's how much sold. Okay. We're going to mainly focus on perpetual inventory before we go any further. Okay, so let me see if I can get over here and find our beginning. Okay, so here is our beginning problem, I believe. I may have to update it just a little bit. Let me see what I got here. So let's get started. Okay, let's get started. Okay, so some of you may have already gotten started. So here is my inventory account. Let me stretch this out a little bit so we can see it. First of all, I would identify what cost flow method we're going to use. Okay, this is, okay, just a second. I want to make sure the cost flow objective. So determine the gross profit for April ending inventory on April 30th. Okay, using the first in, first out, last in, first out, and weighted average cost methods. Okay, so here's inventory, right? So there's no beginning balance. So I'm going to put April 2nd here. We purchased April 2nd. We purchased one for $290. And then April 15th. Okay, let me put this in. April 15th. Let me get this. Okay, there's that one. Let me go back to this one. April 2nd. So there was no beginning inventory, by the way. No beginning inventory. Assume that one unit is sold on April 27th. So we're going to see if we can understand this, okay? If you want to follow along with me. So it looks like we bought 3 items, okay? We got one on April 2nd, one on April 15th for $291, and one on April 20th. One unit for $292. So how many did we have in total? We had 3 items, right? 3 items to sell from, right? So I'm going to add these up right here. They all add up to $873. Let me try this again. Okay, $873. And we sold one. Okay, we sold one. Okay, so if we sell one of these, okay, and this is going to be FIFO, first in, first out. First in, first out. Oh boy. Okay. I'm recording right now, Monty, so you'll be able to follow along with us if you get a chance to. Okay. So if this is first in, first out, first in, what is the first costs that are sitting here? The first costs are $290, right? So the one that we sold, that's the amount we're going to use as its cost. So it's going to go out of here. And then these 2 are the only ones remaining. Okay. So the question they have there is, Okay, just a second. April 20th. So these are our 3 purchases. Okay, 3 purchases in this inventory for these items. Okay, here are the 3 purchases. If we use first in, first out as our cost flow assumption for this one, the cost flow, let me move it over here. Okay, and then the sales price. The sales price is $375. The first in, first out cost is $290. So the gross profit for the one item that you sold using FIFO should be $85. Okay, $85. And if I put $290 going out of here, here is what's remaining in inventory at the end of the period. Okay, so it looks like we've got $583. If it were me, I would draw a T account. So I'll do this one time on the board. Okay, I'm going to do this one time on the board, and I'm going to let you follow my Excel spreadsheet the best you can. So if this is inventory, inventory is an asset that shows up on the balance sheet. Okay, it's what we're going to sell. We had one purchase on April 2nd, April 15th, and April 20th. All of those were different values. Okay, you can't combine costs. You can't combine a cost unless it's the same cost as last time. So there's no beginning balance. We bought one, and one. So we had 3 in total. We're going to sell one. Because this is FIFO, first in, first out, the first one here is $290. So that's the cost of what we're going to sell. Okay. Altogether, we had 873 available, ready to be sold. That's 3 items at a cost of $873. We sold 290. So the question that they're asking here is, what's the gross profit of one item, right? So we sold it. Assume that one unit is sold on April 27th for $375. So I put here, okay, so gross profit. Gross profit is sales minus cost of goods sold. That's what gross profit is. It's a subtotal, all right? So if our sales are $375 each, and we used first in, first out as the cost, we have an $85 gross profit, right? $85 gross profit on that first one. Then they want to know how much we still have in inventory. So if you knock this one out, you now have $583 worth. How many do we have? We had 3, we sold 1, we have 2 remaining. Are you with me? Okay, 2 items, 2 units available for a total at the end of the period for $583. Let's see if I'm right. Okay, I think so. If not, we'll figure out what's going on. Okay, now we're going to turn around and do the other 2 cost flow methods. So I've got them down here, and I just do them separately. So this is going to be LIFO now. I think is what they want next. Yes. Last in, first out. Okay, let me highlight that's the cost flow assumption we're using. And then we are going to use weighted average next. Okay, and we've got more than one purchase. Okay, so we've got April. We've got 3 purchases for each. Okay, so 1, and I need to change the amount. All right, so We got 290, 291, and 292. And those add up to that same amount, right? $873 for 3 items. Okay. Each cost flow assumption will have the same number of units available and sold. Okay. Available and sold. So that's something that you can count on. Okay. So now let's do this one. Okay. So first in, first out. The sales price is $375 each. So what is the last cost that's sitting here? The last cost that came in is $292. So if we take $292 and we subtract from $375, we get an $83 profit. So see how the profit is different based on which cost flow assumption you used, right? So then if we take out the one that's sold, right? So we're selling one and we're selling the 292 one. Here is how much is in ending inventory. This is ending inventory. Okay, this is ending balance. Nope. Nope. Just a second. I've got something going here that I don't want to. Oh, thank goodness for back. Go back. All right. We want the ending balance. Okay, it's always good to check the amount that's available. I recommend you do that when you're doing periodic. This is pretty much periodic right here. This is an explanation of how periodic works. We show how much is coming in, and there was nothing in the beginning balance. Okay, so beginning balance was 0. We had one purchase of the first one that was $290. Second purchase was $291, and the third purchase was $292. So those are 3 units available for $873. Okay, and then last in, first out means using the $292 cost. Okay, $292 cost. So now we have a new balance in ending inventory based on LIFO. Okay, so LIFO's balance based on LIFO cost assumption, the balance in this account now is 581. Profit is 83. Okay, so $83 profit, 581. Here's what I want to show you. Look what's going on. For available for sale, we have the same amount, right? No matter which cost flow assumption we're using. If we're using FIFO, which is first in, first out, LIFO is last costs in, first costs out, and we're just about ready to do weighted average. We found the profit for both FIFO and LIFO. Okay, so that worked out okay, I think. Make this just a little bit smaller so we can maybe see it more in its entirety here. All right, the last one we're going to do is weighted average. Okay, weighted average. So let me put the costs in, 291 and 292. And once again, 873 is the available that we have. But now we want to find the weighted average. How do you find the weighted average of something? Okay, you actually equals all of those added together, okay, a sum. So we're going to average these. Sum, open parentheses, all these added together, close parentheses. And then we're going to divide by 3. Okay, divide by 3. Oops. Okay, so 291 is the amount of the weighted average cost. Okay, weighted average is 291. Does that seem reasonable? Okay, does it seem, let me ask you, does it seem reasonable that 291 falls in the middle of these three numbers? Yes. Yes. So with weighted average, we're actually going to use the one in the middle. Now, please don't get the false sense of security that it's always going to be the amount in the middle. The fact that there's only one item, you would actually have to take however many items times the cost and come up with a total. 1 times the cost, 1 time the cost, and then add it all together. And I added them all together here. Here are all 3 of the costs divided by 3, right? You add them together and divide by 3. Now I'm going to sell one. So when I sell one, here is the, should be the new ending balance. Let me make sure that's the right formula. Okay, the right formula. Yes. Okay, so the profit, if we use weighted average, we get $84 profit. And the ending balance is $582. Okay? What do you think? By the way, this is periodic. This is periodic. And I'm going to put that up here so that you know, periodic inventory. Okay, one more time. What is periodic inventory using FIFO, LIFO, and weighted average? I'm going to read it straight from the book. Periodic inventory. The inventory records are updated only after a physical count has been taken. So you don't try to remove anything from inventory, even when you have a sale. You just let it fall out the way it's going to fall out at the end of the month or the end of the quarter, where we do the physical count. And so periodic isn't used near as much today as it used to because we have computers, right? Since you've worked at Shields and you work at O'Reilly, have you ever had a customer come in and say, I want this, and then you go and the computer says, yeah, we have it, but it wasn't there? Ah, see? Very common problem with every kind of possible store. What I'm trying to get at is having a perpetual inventory system may not solve all the problems, but it's much better than just going all month and not taking anything out and thinking that you're good. Yeah. So we're going to see both examples, but we're going to focus the most on perpetual. Okay. Perpetual. So let me highlight that with a color. I like colors. I bet you can tell. I just like something that catches your eye sometimes for something to remember, right? Okay, we're going to work now, I think, on perpetual. Okay, perpetual. There it is. So let's go to number 2 now. Number 2. And you're going to get, I think you're going to get, okay, this is perpetual. So I'm drawing you a picture here with perpetual. So let me go in here and put the new information in. We're going to use FIFO. Perpetual FIFO. Okay. Perpetual FIFO. There it is. All right. Beginning October 1, we had 61 units at a $25 cost. So let me get this put in here because this was, so they changed their math pretty much each time. So 61 times 25 is what we want for the beginning inventory. 61 items times a $25 cost. Looks like we had $1,525. Okay. We had a sale on October 7th. We're selling 48 units. 48. Okay, 48 units. So we had 61, And now we're selling them, and we're selling those units. They didn't tell us the sales price, did they? Nope, they didn't tell us the sales price, so we just have to go with what the cost is. So 48 times 25 is what we want here. So 48 times the price or the cost. Be sure you say cost. Cost. $1,200. Okay. That was the cost going out. So how many do we have remaining? Can you guys tell me here in class? We had 61 and we sold 48 of something. How many do we have left? Get your calculator out because my brain won't calculate that by itself. It's okay. I could probably if I really pushed it. 61 minus 48 leaves us with 13, I believe. All right, so now we have 13 items at that cost of $25. Okay, 13 items. So I'm trying to show you the cost flow of what's going on here. So we have 13 items at $25 each. Whoops. Okay, because that's the only cost we had. And then I need to change how much that is. So 13 items times $25. That means we had $325 remaining after that first sale. Okay, now it's time for another purchase. We're purchasing 48 more at $28 cost. Let's see. Our first costs were 25. Now they're 28. Yep. That's pretty good. Pretty good. Within the right range. Sometimes looking at what they're telling you. So we bought 48 more at a cost of 28. Okay. So let me put the math in here. We bought 48 times 25. We bought $1,200 more. And when we add the 13 at the $25 cost and the 48 at the $28 cost, let me make sure that's right. 28. $28. All right, we should have available $1,669. Now, how many are we going to sell? We're going to now sell 17 items. Okay. Now, when you have first in, first out, you've got to keep your costs separate. We have a $25 cost. We have a $28 cost. We're going to sell all of these, right? The remaining 13, and then we're going to sell 4 of those to take care of, I'm sorry, let's get rid of let's get rid of the remaining, that's the 13 times 25. Okay, 13 items times 25. Okay, and then if you take, we're selling 48 altogether. We're selling 48. So we just got rid of our remaining 13. Now we'll get rid of 35. Right? So 35 and 13 is 48. Yeah. Uh-huh.
Is Canvas back up?
Yeah, it got back up yesterday.
Okay. I didn't.
That's okay. I've extended the due dates for chapter 5 in the exam. And that's I'll show you that here when we get finished. Okay, I'm sorry to leave you behind, but I got to try to get these videos done so that we can move on. So here's what we've got. We just sold. Okay. We had 2 costs. We had a cost of $25 and a cost of $28. We sold 48 at a $25 cost, and then we sold another 48 where we split the costs, okay? So we only had 13 items remaining when we made this 48 item sale. I know a lot of this starts to get pretty complicated. So the cost of what we sold on October 24th, right here, I got to make sure that these numbers are correct before I put them in. Okay, so now we're doing 35 units at the new cost of $28. $28. So it looks like the cost of what we sold on the 24th, not on the 27th, not on the 7th. Okay. The 7th cost us $1,200, but the 24th is costing us $1,305. So let's put that down, $1,305. So you need to figure out what yours is. You probably have two costs. You probably have a certain amount remaining in each of those cost layers, right? So now at the end, how many do we have remaining? So we sold 48. So how many do we have remaining? Okay, that's the key. All right, so we had 61 and 48, right? 61 and 48. So if we add all these together, and this remainder shouldn't count. So it's okay. So if you have 61 and you buy 48 more and you sell 48 and you sell another 48, you have, I think you should have 13 remaining. Let's just double check this. Okay, let's see if I can follow along here. And the 13 remaining that we have are of the $28 cost. $28 cost. Okay, so I believe that we should have $2,250 left if we add, let me see where we're at. Nope, we have 13. Let me go back. So 13 remain at the $28 cost. So 364, I believe, is where we're at. Okay, I'm going to do this on the board, as I know this gets confusing, but this is perpetual. Every time we make a sale, we're going to take it out of inventory. Okay, so let me get a different marker. Okay, different marker. So I'll draw this on the board one time. Okay, so this is perpetual. And it's going to be FIFO is the cost flow assumption. So we began with 61 items at a cost of $25. Okay, that means we had beginning inventory $1,525. Okay, if it were me, I would write that down, or write yours down for your from your book, but I can't make you. All right. And then we're going to sell. Okay, we have a sale on October 7th. Okay, we're going to sell 48. Okay, 48 minus 61. So all of these are at the $25 cost. So out of here goes $1,200 for that sale. And then we have a remainder, right? So I like to put a remainder down. We have 13 remaining at the $25 cost. So after that sale, we had this much remaining. This much remaining. Now we're going to make a purchase. Okay, we're going to purchase. P is for purchase. We're going to purchase 48 at a cost of $28 each. Okay, 48 times 28 is $1,344. Okay, now we're going to turn around and we want to know how much is available. Okay, available. That's actually what this is. Available after the sale. Always want to keep track of how much is available. All right, so if you sell 13 plus 48, okay, then that's 61. We had 61 available. And then, but you have to add these two numbers together. You can't take 61 times, because they have different costs. So we have 325 plus 1344. $1,609 is how much we have before the next sale. Because this was a purchase on 10/15. Okay, this was the beginning balance, purchase on 10/15. This is, now we're gonna do another sale. So a sale on 10/24, we're going to sell 48 items, right? If this is first in, first out, all of these are sold. So 13 of the $25 costs. So 325 is part of that sale. And then we're going to do, to finish up, is 35. Okay, 35 times the $28, right? And it is $980. So if you add it together, this is the sale on the 24th. Okay, the sale on the 24th. So when you add these two together, you get $1,305. Okay, $1,305 is the cost of what was sold. This is the cost of the goods sold. Cost of the goods sold on the 24th. Okay, now we need an ending balance here. Ending balance. How many items? We had 61, we sold 48. That means that we have 13 still available at a cost of 28. $28 is the last cost that came in. So 13 times 28 is $364. There's your ending balance. So here is your cost of goods sold, which should be $1,305 for 48 units. I got to change that. 48 units. 48 units. Make sure that that is reflected here. There were 48 units sold at a cost of $1,305. So you'll want to put that down. And then what is still remaining in inventory is $364. Remember, we don't report how many there are in inventory. We report their value, right? Their value. Okay, why? What now? Just a second. Oh, guess what? The sale was 17, not 48. I apologize. Let me go back and fix this. But it won't take much to fix this. Okay. Back. All right. So this time we're selling the first sale was 48. The second sale was 17. That's better. Okay. So we're going to sell the first 13, right? Of the $25, that's fine. Okay. And then we're going to sell 4 more at 28. See why it's good to make notes of what you're doing so you can go back and fix it. All right. So then the 4 at the $28 cost equals 4 times $28 is 112. So the cost of the goods sold, according to mine, is $437. Okay, now how many do we have remaining, right? If we had 61 available, 13 plus 48 is 61. We had 61 units available at a cost of $1,669. Now we've sold 17. So 61 minus 17 is 44. We have 44 units remaining at a cost of $28 each. Okay, 44. So now let me see. Now let's put this in. The cost of the goods sold should be $437, and the ending balance in inventory should be 44 items at $28, and that should be $1,232. So now let me put this in, $1,232. This can get very confusing if you don't, obviously I didn't pay attention. I missed the sale. I thought they sold 48. Sorry about that. Okay. First costs in, first costs out. So the first costs that were sitting here with the $25 cost, they went out the door. So what remains in ending inventory is the highest cost items, and we're also going to assume that costs are going up. Okay? Costs are going up. They were 25, now they're 28. We had 61 to begin with. We sold 48. We had 13 remaining. We bought 48 more, which means we had 61 units available to sell at two different costs. So when we sold 17, we sold out of all the $25 cost items, and then we sold 4 of the newest $28 items. And that means we have 44 items remaining times that $28 cost. Okay. All right, let's go to the next one. Gotta keep moving here. Okay, now let's do the same problem, I believe. This is going to be with, nope, it's a different problem with LIFO. Okay, it's a different problem with LIFO. What does LIFO stand for? Last costs in, last costs in, first costs out. LIFO, last costs in, first costs out. So we are July 1. We're starting with 98 units at a cost of $31 each. So we have a beginning inventory. Beginning inventory, 98 units times the $31 cost. I got $3,038. Okay. I'll try to be more careful now this time. July 8th, we had a sale. When you only have one cost, that's all you can sell out of. Okay. The sale is 78 units. All right. 78 units at a cost of $31. Okay, and I need to do the math here. Let me make this a little bigger for you to see. Okay, so there's that T account that's got my inventory in it. Okay, we're selling 78 times 31. So that's 2418. Okay, then we have a remainder. So I'll just put available. Available works just fine. So if we had 98 and we sold 78, we have 20 remainder, 20 available after that sale. So if you're using perpetual, you always know how many you have remaining. Okay, so we have 20 items at the $31 cost. So we now have $620 worth of items. There's 20 left. Okay, here comes our sale on July 15th. Here comes a purchase. Here comes a purchase. We're going to buy more. What was $31 is now $35. Okay, so we're buying 109 items at a $35 cost. 109 items at a $31 cost. Okay. 109 times 31 is $3,379. That's the purchase we just made. And this is at 35. So let me go ahead and make sure that gets changed. Make sure I put that in right here. Okay, the cost has jumped. Yes, it's jumped to 35. There we go. So here's the old, right? Here's the first cost that were sitting here, but which ones came in last? The $35 cost. So this sale on July 27th is going to sell out of these last costs first. Okay, that may sound really weird. Okay, so the sale is 92 units at a cost of $35 for me. Okay, cost of $35. So 92 units times 35. 3,220. Okay, that should be the cost of the goods that we sold. So 3,220. You figure yours. Now I'm going to figure out how much inventory is still sitting here. Now here's the thing. Did we get rid of all of these first costs? No. There's still 20 here, right? Yep. So we've got to put those 20 down here. They're still waiting in inventory at their $31 cost. Okay. And then, so once a cost changes, you cannot combine them with another cost. So our $31 cost tier cannot be combined with our $35 cost tier. So we had 109. After we sold 92, how many do we have? 109 minus 92. Okay, let me do this again just to be able to check. 109 minus 92 is 17 remain. 17 remain at a cost of 30, at a cost of, and that would be, no, purchased. Okay, so here's the remainder down here. There's 20 left at the $31 cost, and then there are 17 remaining of the $35 cost. Okay, so I will do the math here. 17 items times 35 is $595. And if you add these two numbers together, the ending inventory is $1,215. Okay, let's see if I got it. Okay, I think so. If you're lost, maybe you ought to try drawing some T accounts and following along with what I'm doing here, if you can. All right, let's go to the next one. That was, so we did LIFO and FIFO. We did FIFO and LIFO. Now we're going to do weighted average. Okay, weighted average, new problem. But this is perpetual weighted average. So I would find out whether it's perpetual or periodic first. It'll tell you in the problem. And then it'll tell you what cost flow assumption to use. Okay, FIFO, LIFO, or weighted average. All right, this is where we're at. So we've got perpetual weighted average. And to most students, weighted average tends to make the most sense, okay? So on October 1st, we have 310 items at a cost of $8 each. Okay, so let's put the beginning inventory here. So 310 items times $8 each means we had $2,480 in beginning inventory. Okay, then on October 13th, we're going to make a sale, right? Make a sale of 160 units. 160 units. 160 units. All right. Do you know the cost of these? Yeah. They were $8 each because that's the only costs we had. So they want to know the purchase. Okay, so we'll just keep going down through here then. All right, so 310 items were there and we sold 160. So we need an available, you need an available amount after every sale. After every sale, you need available. Okay, so 310 minus 160 is 150 items remaining. 150 items remaining at an $8 cost. Okay, we don't need a weighted average until we buy more that our costs have changed. Okay, so here's how much is still in inventory after the first sale. The first sale is October 13th. So 150 times $8. There were $1,200 left over, $1,200 in inventory after this sale. Now here comes a purchase. Here comes a purchase. We're going to buy 350 items at a $10 cost. How much was our cost before? 8. So our costs are going up. Okay, that's what we expect them to do. Okay, we're buying 350 items at a cost of $10 each. Okay, so that means we added 350 times 10, $3,500, right? $3,500. Now you've got to average the cost. You've got to average the cost. All right, so here's how we do it. I'm going to do the average down here. Okay, the average down here, weighted average. Okay, so you've got to add your items together and do the math. Okay, so on October 22nd, okay, we're selling 300 units on October 29th. Okay, the weighted average after the 1022 purchase. Let me put this in here. So just a second. So the weighted average cost after the purchase. So we had 150 items times an $8 cost. This is after the purchase. Okay, so 150 items times 8. Okay, that's 1,200, right? 1,200 there. Then we bought 350 at a new cost of 10. Okay, 350 items times 10 is $3,500 worth that we bought. Okay, that means we have 500 units. 150 plus 350 is 500 units. Okay, and we're going to add them together and we're going to divide by. All right, so let me do the math here. All right, so all of this added together equals sum. We're going to add these. Okay, so there's 4,700 units. No, there's 500 units after that October 22nd sale. We're trying to find the weighted average of before we sell in October 29th. So hang on a minute. So if we have 500 units, we need to divide $4,700 by 500 units to find the weighted average. Okay, $4,700 divided by 500 units should be somewhere between $8 and $10. Okay, it's $9.40. $9.40 is the cost. Okay, so we sold 300 units, and that's how much the cost will be, $9.20. Okay, $9.20. Okay, and then I need to capture how much that is. So 300 units times $9.20. That's $2,760 is the amount that we sold. All right. The first question is, what is the average cost after the 10/22 purchase? Okay, it's $9.40. $9.40 is how much that is. Okay, assuming a perpetual inventory system and using the weighted average, determine the cost of goods sold on October 29th. On October 29th, we sold 300 units at an average cost of $9.20. Okay, so we'll calculate that right here. $9.20. It's 2760. 2760 is how much? There it is. It matches. As long as that matches with this, we're in good shape. See, we're checking ourselves here. 2760 should be, no, okay. Let me see what's going on. The 2 decimal places. All right. Let me see what we got here. So one more time, we have 150 items at $8 each. Okay, yep, that's 1,200. Then we had 350 at 10. Okay, let me just make sure I'm calculating this right. We had 310 units. Then we sold 160. That left us with 150. Then we purchased 350 more. So that is 150 plus 350 is 150 plus 350 is 500. Yes. So we have 500 units. Why is it not? Okay. Assuming, determine that the cost of goods sold, assuming a perpetual inventory system using the weighted average method, determine the cost of goods sold. So we sold 350. There it is. I know why. We're selling 350, not 300. So it's the change of the version that I have is why it's wrong. So I've got to find where those changes are. Okay. So once again, 350 units sold at 920. 350 units at 920. Yeah. There it is. 350 units at 920. So this should match the amount that's coming out of that T account, 350. So now let's put $3,220 is how much should be the cost of the goods sold, I think. No? Oh boy. Now what? Okay. Okay. So we should have let's see if I can work through this, see where I've gone wrong. Let's start over. 310 units at $8. 310 times 8. That means they had $2,480 in inventory. They sold 160 of those. Okay, because that's the only cost they had. All right, and that left 150 at an $8 price. So that's fine. And we've got the 940. That's good. That's good that is, and it's the 940. Boy, I am just not following myself. So here we go. That average changed. Okay, that average changed. So luckily you have software to do this. Let's try 3290. I believe that should be right, and I'll show you why. It's still not, is it? Okay, let's keep going. Let's keep going. So G 167. Okay. Okay. So 500 units. There's 310 plus 150. 310 minus 160 is 150. Then we added 350, which gave us 500 units at a cost. Okay, so then we had $4,700. divided by 500, and 940 is right. Assuming a perpetual inventory system, use the weighted average method. So if you, I keep combining things. Let's try this one more time. This last sale is 300 units. Okay, last sale is 300 units. So that's going to give us a different number. The average is the 940. Okay, so I really hosed this one up. But they have so many similar numbers that it's just about to kill me. All right, that we know is right. Now we sold 300 at 940. Okay. Now what? Okay, we sold 300 at 940. So you really have to pay attention. And I'm not paying attention very well because I'm trying to talk at the same time. So, all right, let's try this one more time. 300 units that we're selling at the cost of 940 is 2820. Okay. This is my third time as a charm, I hope. 2820. Now let me double check. We're selling 300, yes, at the average cost of 940, which we've already put in to prove that we're right. There we go. So the cost of the sale was that we sold 300 units at 940, which is that average cost. Okay. And then the ending inventory should be, all right. So we should have 200 units in ending inventory because we had 500 minus 300 is 200. And those should be 200 at the 940. Okay. 200 units at 940. Okay, now let me do the math here. This is the ending inventory. So you definitely can get very confused and off track. Okay, here's the thing. These two numbers should add up to these 500 units. If I add 2820 and 1880, yes, I get $4,700. So there is where you can check yourself. So what's still in remaining inventory at the end of October is 200 units at the average cost of 900 or average cost of 940 each. Okay, so let me see what I have here. This should, okay, those add up to that. Okay, just got to find where all my formulas are. There you go. 1880. Yes, they agree. 1880 should be the right ending balance. Okay, so it's good to keep track of the number of units. That helps you think about how many's out there. But then you've got to sometimes keep track of a lot of other things. All right, let's keep going. See if we can get through this. I don't know if we're going to be able to get through what I had planned, but we'll do what we can. Okay, here comes periodic. In fact, sometimes I would just rather do periodic. We're going to do periodic 3 ways. We're going to do FIFO, LIFO, and weighted average, and I will see if I can concentrate better. Okay. So we're starting with January, beginning inventory. We've got 40 units at a cost of $170. So let's put that in. 40 times 170. So 6,800 is how much we have in the beginning inventory. I'm going to do weighted average first. Okay, I'm going to do weighted average first down here in the bottom. Okay, so we're going to go through this 3 different times and show you based on a cost flow assumption that you can get different answers. Okay, when each of these cost flow assumptions are, you can use them. You can use them. GAAP doesn't care which ones you use, just as long as you disclose what method you're using. Okay, what method you're using. Okay, so let's see if we can wind our way through my little spreadsheet here. Okay, we're good here. Yeah, beginning inventory, 40 items at 170 a piece. Okay, now we're going to purchase. Going to purchase 150 items at a new cost of $180 each. So our last one costs 170. So that seems to be reasonable. We're buying 150 more. So we want 150 times 180. 150 units times 180. Just want to double check that I put that in right. Then we have another purchase, okay? A third purchase, 30 units at a cost of $190. So we've got three different costs. We got to figure out what to do with these, okay? So 30 at 190. And what we're going to do is weighted average first. If you're required to do weighted average, LIFO, and FIFO with periodic, you might as well just go ahead and do your average first. Okay, we've got 40 plus 150 plus 30. That's how many items we have. Okay, 40 plus 150 plus 30. We've got 220 items. Okay, 220 items. So we need an average cost of the items. Okay, so it's going to be somewhere between $170 and $180 a piece. So the total is 45,800. Okay, so I'm going to show you this in so you can see it. You take 45,800 and divide by your number that you have, items. Okay. Okay, we're going to divide by 220. That weighted average, and I've got to put that in here, 45,800 divided by 220 should be 208. 208. Let me double check. 45,800 divided by 220. Okay. All right. Now let me see if that's going to match up here. Okay, so this is, okay, all right. So how many did we sell? Okay, we are selling, there are 80 items left in inventory. So down here in inventory, we've got 80 left over at a cost of 208. 208. Okay, I'm going to do the math here. We've got 80 units times their average cost of 208. So we've got 16,640. Okay, which means if we had 220 and we have 80 left over, then that means that, all right, so let's put 220 minus 80. 220 minus 80. Okay, 220 minus 80. Whoops. Just want to show you that up here above. 220 minus 80, right? Is 140 items, okay? 140 items that we sold at a $208 weighted average, okay? $208 weighted average. So how many did we sell? 140 times 208, okay? 208. Wait. Okay, let me make sure. Because I'm off just a little bit. All right, so let me make sure I've got all these in. 40 units times 170, 150 units times 180. There it is. There's where it's off. Okay, 30 units times $190. There we go. So those two. Okay, there's how much we have available. Okay. Let me make sure that I'm reading this right. Okay, 140 units sold at 208. Okay, let me double check that this is, hey, nope. No, something's different. Okay, so this is these two added together. Okay, and then that's those added together. So 39,000 divided by, so I got to figure that out. Okay. 39,500 divided by 220 is a different number. 39,500 divided by 220 is 180. Okay, so we got a little bit of polishing up to do here. Okay, 180. So 220 units is how many we had available, minus 80. That means we sold 140 here. It's 140 times 180. We have 80 units remaining, and their cost is actually $180. Okay, so this $180 ought to be right here. We have 80 units at $180. So these two numbers, that's why I have this twice. Okay, this is why I have this twice. If you add up all of what we bought, 40 items, 170 we had in the beginning. We bought 150 items at $180 cost, 30 items at $190 cost. We had 220 items to get all together with a total cost of 39,500. So when we got down to the bottom, we had 80 remaining. That means we sold 140 out of here. And those 80 times 180 gives you 14,400 in ending inventory. These two numbers must add up to what's available, always. That's why I have that check there. All right, so this is weighted average, and this is what they want. They want determine the inventory cost using the first in, first out, last in, first out, and weighted average. So your weighted average is going to be the inventory cost, 14,400 at the end of the month. Nope. Okay, what does this say? There are 80 units in physical inventory at the end. Determine the inventory costing. Inventory costing, okay, let's try it this way, 25,200. Okay. What are they asking for? Okay, I guess I'm just really hosed up. Sorry about that. Okay. Yeah, there's that, 39.50. That's good. Okay, so then we had 220 items. Minus 80 is 40. We've got a cost of 180 here. Okay, why isn't that? Okay. All right, guess I'm gonna keep working here. Okay, what have I missed? Too many formulas, I think. Okay, 80 times 150, and they want, there are 80 units. The periodic inventory system is used. Determine the inventory cost. Round per unit cost. Oh, per unit cost. Per unit cost. Determine the inventory cost using the first in, first. Okay, we're just using weighted average. round per unit cost to 2 decimal places. Well, okay, so they want 2 decimal places. That's what's wrong, I guess. So instead of 180, they want it further out. There it is. There it is. Okay, so they're getting that picky, huh? Okay. All right. Wow. 179.55. I didn't know they got that technical. Okay, 179.55. Let's try taking these to greater decimals here. All right, let's see here. Let's go this way for the decimals, and we have to make sure to use 179. Well, they've got you really down to, yeah, 179.55. Okay, 25, 137. Okay, then the 80 units times the 179.55. Wow. Okay, that's something new. $179.55 is what we got for the unit cost. Okay, so now I want to substitute that amount in. So 80 units times 179.55. I got to extend that out. Is that right? Do what? They do? Okay. Let me see if I got it now. 14,364 is what I have in inventory. Whew, my gosh. They haven't ever gone down to the pennies before. Sorry. Oh, okay. Now let's run it through FIFO. Okay. I'll see if I can't keep doing better. All right. Here we go. FIFO, same problem, but all right. So let's go. I'll just put down what they're showing. Okay. They're showing how much it's worth. $6,800. Okay. 150 times 180. They gave us the number there. That's nice. 27,000. Okay. And then 30 units times the $190. And I don't have to calculate that because they're giving that to me. So am I matching? 39.50. Okay. And it should be 220 units. That's what they're showing available for sale. Okay. That makes it a little easier. 220. Okay. Now we got to do, this is first in, first out. So how many are we selling? We're selling 80, right? 80 units. So are you heading out?
Yeah, I got one.
Okay. Thanks for coming in. All right. We got 80 units. No. Okay. It says that we sold it's okay. We have 80 units still here, right? Down here below. Okay. Let me go ahead and put in. Okay. First in, first out. So all of these are gone up here at the top. So they say we have 80 units in ending inventory. I'll put 80. Those 80 are made up of all of the, okay, so we've got 3 different costs here. So we're selling 220. No, we're selling 140. 140 plus 60, right? Double check that. 140 units is what we're selling plus 60. Okay. If you have 220 and you subtract 80, you have 160. There you go. 220 available to be sold minus the 80 that's still in inventory. That means 140. Okay. And just 140 plus 80, 220. Yes. So this is the number of the units that we sold. Units sold. Okay. So And now I've got to go down here and put these in. So 80 are all 30 of these, right? So all 30 of the last ones sitting there are still there. So the 130, the 30 plus the 30 times the 190, okay, equals what you see here. And then we need 50 items still sitting here of the $180 cost. So 50, this one should be better. Whoops. 50 items. There's 50 items at the $180 cost. So let me see if what I've got going on here. So those two together should be 14,700. Let me just double check. So one more time. If first in, first out, that means that all 40 of these are gone and 100 of these are gone out of here, right? Yep. Okay. And if you add up these two items, do they add up to the same amount? I like to double check. So let me add these two. This is my verification. Yes, they do. So I'm pretty confident that this is our ending inventory for FIFO. Okay, ending inventory for FIFO. Now we'll do it for LIFO. Okay, same scenario, same problem. Okay, so 40 times 170 is 6,800. 150 times 180. So you just have to look at it from each cost flow's point of view. And then 30 units at 190. So once again, 220 units. They did us a favor by doing the math for us there. Better than I did. Okay. So that's going to be 5,700. This should match what this shows. And the available is 220. Okay. So that means we're selling 140 units. Units sold 140. Okay. That means we have 180, or we have 80 still remaining. Okay. And this is LIFO. So LIFO means that these last ones are still hanging in there. Okay. So 40 at the 170 cost is your 6,800. And then the rest is 40 at the 180 cost. Okay, and I got to do the math inside of there. So this should be good, I think. All right, 14,000 is how much if you used LIFO. Notice they're all within the same range, right? They're all within the same range, thankfully. Weighted average is always going to fall smack in the middle between first in, first out, and last in, first out. Okay? It's always going to fall smack in the middle. Okay? Let's keep going. See if we can. This next one is not too bad. It's called lower of cost or market. Okay? Lower of cost or market. So this is just an example of how it's done. Okay? So sometimes if you go out to the market, you'll find out that your inventory is overvalued. Okay. Sometimes inventory becomes overvalued because technology brings the price down. Okay. We've got two items here in inventory. So we're going to use lower of cost or market. All right. So here is what it cost us. Here is what the market says it is. So I'm going to give you an example of how this works. So we've got two of them. Let's go out to Excel here and let's see if we can put these in, and then we'll duplicate what we're, all right. So what is the cost then? Your first item, we've got 5,200 in inventory, right? So equals the cost. It's 5,200 times $29. Okay. The market for that item is 5,200 items times the value in the market. Okay. The market is higher, right? The market is higher than what we paid for it. Guess what? We keep the cost. Okay. We keep the cost. Whichever one's lower is the one we're going to keep. Okay. Now let's do this one. The cost of 10,452 items times $14 cost us $146,328. Now, the market value is down to 9 now. So our market value is going to be lower. Yep. Market value is going to be lower than our cost. We're going to keep the market. Okay, we're going to keep the market. So we've got to mark our inventory down. So I'm going to show you this in this scenario here. Okay, so I'm going to show you the first one, right? So the first one cost us $150,800. Okay, $150,800. Oh, I know what this one is. We don't have to mark down the first one. Okay, this is for item SAW9. SAW9. So let me put the item number up there. So if SAW9 cost us $146,328 and we want it to have $94,068, then we've got to do an adjustment. Okay, the difference between these two, right, is the cost. The difference between what we had on our books and what the market says is $52,260. Okay, that's the lower of the cost or market. So we're going to mark it down, right? The adjusting entry, let me go back. Okay, so the adjusting entry is going to bring down inventory here. Let's go ahead and put it out here in our problem now. So here's what we've got. It says, and input your answers in the questions below. Well, on the basis of the following data, determine the value of the inventory at the lower of cost or market. Okay, so we're going to add, so the new balance, and I'll go back to my spreadsheet a minute. Okay, so if you add these together, then we need a total here. Okay, we need a sum. So we go equals sum, open up your parentheses and click and drag, right here, and enter. Okay, and then you can actually move that formula with a red X over. All right, so now our inventory, this is just the one item that we had to change, right? We could keep the one that was lower than market. Okay, we could keep the one that was lower than market. Here's our new total. Okay, so this is the new total for this. Here's the item SAW9. Okay, and then let me go ahead and put the other item in. We'll add them together. So that's what they want. Okay, this is the item. So we get to keep 150,800 for JFW 1. Okay, we're going to add down here. And that's $244,868. Okay, so I'm going to put that in my problem now. So this is the new balance of our inventory. The new balance of our inventory, because we applied the lower of cost or market. So you have to take each item and see which one's lower. Okay, which one's lower? One more time out here. when we did the math, we did the cost of all of our items, 5,200 times 29, then 5,200 times the market value, and we keep the lower of cost or market. So we keep the 150,800. But this item, when we went out and priced it in the market, was actually lower than what we paid. So we can't carry our inventory at an inflated value. Okay, that's inflated compared to what the rest of the market is selling it. So we had to bring that second item down, right? Second item down. So now our inventory, when you add the two together, is 244,868. So you'll need to do the math for yours. Probably one, the cost will be lower, and one, the market will be lower, but you got to add them together to see what the new value of inventory is. Okay, I'm going to get these other two done. Okay. Woo! Now this is kind of tough, but I'll help you with it. Okay, let me see here. This is 6, 7. Okay, 6, 7. It says during a physical inventory, okay, during a physical inventory at the end of the year on December 31st, we incorrectly counted its inventory as 730,200. So I'm going to put down the incorrect physical count. This is in dollars. Okay, this is in dollars. How much did we miscount? What happens? Why do we miscount? Because we're human. Yeah, sometimes we miscount. So here is the incorrect physical count. Here's the actual physical count. If I went, so it's 727,100. So the difference is $3,100. Okay, the difference is $3,100. So I'm going to show you this. Okay, I'm going to show you. It says, indicate the effect of the misstatement on Waterjet Bath's December 31st, 2000 year 3 balance sheet and income statement for the year ending December 31st. Now this can be a little bit tricky. Okay. So remember, inventory is an asset, right? It's an asset. It gets reported on the balance sheet. So I'm going to put balance sheet here. So whatever's going on with this asset is what's going on with the other assets, what's going on with the balance sheet, okay? So if we thought it was 730,200, but the actual physical count was this, that means that our asset was overstated, okay? It's on the balance sheet. It is overstated by $3,100. Okay, $3,100. Let's see if I'm on the right track. So if inventory is an asset, then yes, current assets are reported on the balance sheet too, and therefore current assets will be overstated by that same amount, just as long as there weren't any other errors. Okay, I'm going to finish this video, so if you guys need to go, that's okay. So total assets are on the balance sheet. All of the assets are overstated if we don't change it. Okay, so yes, all of those are that way. Now, here's the thing. This also gets counted as cost of goods sold. Okay, so as inventory goes down, that's the amount cost of goods sold also goes down. So that means cost of goods sold. So we're looking at it from the assets point of view right here. The asset difference is asset overstated. Asset overstated. Okay. Then cost of goods sold. See you later. Thanks for staying. Cost of goods sold. Okay. So if this didn't get put to cost of the goods sold, then the cost of goods sold is understated. Understated. No, I'm not answering that. Okay. So if we didn't whatever the asset is, the cost of goods sold is understated by that much. Okay, so cost of goods sold gets reported on the income statement, and there's not enough in it. We didn't move it out of inventory. If you don't move it out of inventory, then the costs are understated. Gross profit, ooh, look out, this becomes overstated because cost of goods sold gets subtracted from our revenue. So we actually missed, right? Cost of goods sold is understated. That means gross profit is overstated. There's too much in it. We needed to subtract another $3,100. So gross profit is understated. So let me get these words out of here. I know it's hard. I had a very difficult time understanding this. So overstated. All these are overstated. Assets overstated, current assets are overstated, total assets are overstated. Then the one that gets the opposite of if not enough came out of inventory, not enough went in cost of goods sold. So it is understated by $3,100. Okay, which means gross profit is overstated. Yeah, because it's not enough expense against the revenue. And if gross profit is overstated, so is net income. Yep, because it's still going down. So it's overstated 3,100. And so is your stockholders' equity because net income goes to stockholders' equity. That's why I saved it until now. Okay, so this is going to be net income will be overstated. Okay, got too much in it because we forgot or we didn't put enough in cost of goods sold. So if cost of goods sold doesn't have enough in it, then your gross profit is overstated, and so is your net income. And remember, the result of net income goes into equity, and equity is on the balance sheet. It is overstated too. So we actually need to go back and repair these financial statements because one little miss up in the count of inventory, look at all the problems, right? Look at all the problems. One misstep. The actual count was this. And we counted it for more than that. So all that from one little error of $3,100. Yep. Okay, last one. Last one, we'll call it good. So this is inventory turnover. Okay, inventory turnover. Turnover means that you are how quickly you're selling your inventory. How quickly are you selling it? Right? You want to sell it as quickly as possible. Boot Barn wants to sell their inventory as quickly as possible. Get it out of here. The sooner you can get it out of here, the quicker you turn it over. Okay, that's the idea. So let's see what they've got here. They've got year 7 and year 6. Let me put the cost of goods sold in here. 3,636,860. Okay. Then we've got 3,902,580. All right. The average inventory. How do you get average inventory? You take the beginning and the ending and add them together and divide by 2. Okay, so I think I've got that. Yes, I add these two together and I divide by 2. So this is the average inventory. Let me go ahead and get these now, and I need to put this in my Excel spreadsheet. Okay, so I've got them in my Excel spreadsheet. Now I'm going to put it in for the problem. So open the spreadsheet. Okay, so turnover, and this is going to take a little bit. So the turnover is, here it is, cost of goods sold, which is what this is, divided by your average inventory. So we're going to come up with inventory turnover and number of days sales. Okay, so all right, let me go here. Let's see here. We want inventory turnover. So we want cost of goods sold. I want to go right here, equals cost of goods sold. Where are you? There you are. Cost of goods sold divided by, we're going to put parentheses around these two amounts. If you don't get two amounts, you can only use one. Okay, and that gets divided by 2. And then that goes in its own set of parentheses because we want that to happen. Okay, let's see if I got the right answer. Okay. So I got equals this divided by this. Let's see if it's 4.7. Okay, yes, go ahead. Yes, 4.7. And all right, so now we'll do that one for this one from the year before, equals the cost of goods sold. Actually, well, I'll just do it that way. Cost of goods sold divided by, open parentheses, we'll put 2 in. We want the beginning inventory plus the ending inventory, close parentheses, divided by 2, close parentheses. Enter. So 5.4. Yep. There's the 5.4. And then the number of the days sales in inventory. So this is telling you how many days is it going to take to turn over that inventory, to turn it over, right? If you're turning over your inventory 4 times a year, that's 90 days. 90, 90, 90, 90. Well, we're turning it over a little more quickly than that. We turned it over faster last year than we're turning it over this year. So that might be a little unfavorable. So something's going on that we're not selling as fast. Okay. So how many does it take? So what we're going to do is take, and here's the average inventory, right? So we've got to do a little calculation here. So here's what I got. Okay, so we take the average inventory. So this is what it is now, the average inventory, which is sitting here, and we divide it by cost of goods divided by 365. Okay, because there's 365 days in a year. Yes. So what we want is equals the average. Okay, so we got to do the average assets. So we have equals, I think, come on, equals. Okay, so we're going to open up our parentheses and do beginning plus ending divided by 2. Okay, we got to get a few more parentheses in there. So we want that in there. That's going to give us our average inventory. And then we want to take our cost of goods sold, which is right here, and divide it by 365. Okay, so we've kind of got a division problem, both the numerator and the denominator. All right, so what did I miss? I got to do parentheses around the whole thing. There we go. I think. No? How many do I got? Let me do this. Okay, I need parentheses around those 2. And then parentheses there. And then I think I'm okay. Maybe. Hang on just a second. Let me see if I can get this. I got to start over. All right. So we got to do the average. Okay, which equals. open parentheses, plus, all right, close parentheses, divide by 2, and then we've got to do parentheses around all of this. This is where algebra kind of comes in. All right, and then we're going to divide this whole thing by, okay, because it's the average daily cost, the average daily cost of goods sold. So if this is your cost of goods sold divided by 365, hey, 67, okay, 67.59. Okay, so I don't know if they want 1 decimal or 2. I have to go look. There it is. Okay, we're going to do this again. Equals, open parentheses, go get your beginning inventory, add it to your ending inventory, and then you're going to divide that by 2 to get an average. Okay, when you've got to put another set of parentheses around this. This is the numerator. Now you're going to divide by another set of parentheses. Cost of goods sold divided by 365 days. I put the number 365, I think, in the last one. There it is. So 77.7 days and 67.6 days. Let's see if that's what we got. Yes, I'm still here. Okay, so the turnover, right? The turnover, and they want it to 1 decimal place. The turnover is 4.7. That wasn't too bad. Okay, the number of days in sales is actually going to be a little tougher. So 77.7 and 67.6, I believe. So this direction means that things are not better. They're actually maybe getting a little worse. That's unfavorable. They're taking longer to sell what is in inventory, and that is considered unfavorable. Okay, unfavorable. That's it for the intro exercises. So obviously we didn't get to chapter 7. So we will just work with this chapter first, okay? 2 chapters is just not going to work. All right, we'll finish up chapter 7, and I'll push 8 out a little bit, okay? We'll finish up chapter 7 on Monday, okay? Monday. So please look at the new due dates, all right? And I'm going to go ahead and end my recording now, so that I got that done at least. Okay, so stop the recording.